Welcome to another deep dive. Today, we're plunging into the really high-stakes world of central banking, specifically the Bank of England, as they gear up for, well, a pivotal decision.
Absolutely pivotal.
Our mission, to unpack the complex factors influencing the Bank of England's highly anticipated rate cut. That's expected August 7th, right?
That's the day everyone's watching, yeah.
We're drawing our insights from expert economic and financial analysis provided by ING Think, giving you a shortcut to understanding what's truly at play in the UK economy right now.
And what's fascinating here, I think, is how this action, cutting rates, it seems straightforward, but it actually masks a deeply nuanced picture. There are underlying tensions that make this far from simple. So we'll explore the data points driving this and what they really mean for the broader economic landscape you're navigating.
Okay, so let's start with the headline then. The Bank of England is almost certainly going to cut rates by 25 basis points.
0.25%.
Right, bringing them down to 4% from the current 4.25%. And this would continue what's described as a well-established pattern of quarterly rate cuts. But, for an economy still dealing with pretty persistent inflation, how does this seem? Is it universally welcomed?
That's a really great question because, while it sounds like a decisive move, the analysis labels this as cautious action. This isn't just slow, it's really a testament to how finely balanced and frankly contradictory the UK's economic signals truly are right now.
Okay.
The bank is being forced to walk an incredibly narrow tightrope, weighing a lot of different factors, and that caution is crucial.
That makes perfect sense. So if they're being cautious, what's the primary justification for them to even consider a cut right now? What's the main concern driving this expected decision?
Well, the core argument for the rate cut really rests on the UK jobs market. It's described as creaking with slack undoubtedly building.
Creaking. That's a pretty vivid word.
Huh.
Can you walk us through the specifics? What data points paint that picture for the jobs market?
Absolutely. So we've seen payrolled employee numbers fall in 7 out of the past 8 months. That's quite a trend.
Yeah.
The unemployment rate, it's risen by a few tenths of a percentage point this year. And crucially, the data now looks more reliable than it has been in recent years, which gives it more weight.
Right.
Even vacancy data from Indeed suggests the UK jobs market has cooled more than in other major economies. So, on the surface, it looks like a clear signal.
Okay, so that's the employment story pushing for a cut. But you mentioned nuances before. Does this weakness mean the overall picture isn't quite as grim as maybe those headlines imply?
Yeah, that's a really important distinction to make. While the numbers show weakness, this is largely a slow-moving story. A lot of this decline, for example, is concentrated specifically in the hospitality sector.
Ah, okay.
That sector's been disproportionately affected by recent hikes in the national living wage and payroll taxes.
I see.
So far, these declines don't appear to be broadening out significantly across the private sector. And crucially, there's no discernible increase in redundancy notices. The real takeaway here is that despite the headlines about a creaking jobs market, the bank isn't seeing that widespread systemic weakness that would maybe trigger a more aggressive policy shift. There's no smoking gun yet, as the analysis puts it.
No smoking gun. Okay, interesting. So the jobs market provides a sort of cautious justification for a cut. But now let's pivot to the inflation data, which, as you said, paints a very different and seemingly more stubborn picture. The analysis says inflation is still proving sticky, creating an uncomfortable situation for the bank. What are the key elements of that stickiness?
You're right. It's definitely uncomfortable. Services inflation, which is a key metric the Bank of England watches really closely, is stuck at 4.7%.
Still 4.7. Wow.
Yeah, and that's fractionally above the bank's already fairly high May forecasts.
Oof.
What's equally uncomfortable is that headline inflation has actually risen to 3.6% in recent months. Plus, food inflation picked up above what the BOE had predicted, too. It's a tricky balancing act.
So if we connect this stickiness to the bigger picture, what are the bank's biggest worries, particularly long-term? Is there a risk they're cutting too early, potentially reigniting inflation down the line?
That's precisely the central dilemma they're facing. A lot of what's keeping services inflation elevated is linked to things like tax rises or rents, which should, in theory, contribute less in coming months.
Should. Okay.
But the catch is, many prices are set annually in April. So that means we probably won't see a material improvement until next spring. It's likely to stay above 4% for now.
Right.
Furthermore, the bank, and particularly chief economist Hugh Pill, is known to be very sensitive to headline CPI when it's in that 3.5% to 4% range. There are concerns about inflation becoming sort of embedded in the economy, So yeah, they're expected to nudge up their inflation forecast next week, which tells you they're not fully comfortable yet.
Okay, so here's where it gets really interesting, I think. Despite this expected rate cut, the analysis highlights stark divisions among policymakers on what to do next. A three-way divide looks highly likely, some voting for no change, some for the 25 BP move, and some even for a more aggressive 50 BP cut.
Exactly. That's quite a spread.
Wow. So even the most informed experts within the bank are deeply split on this.
Precisely. And the insight here is that this isn't just some academic disagreement. It's a live debate shaping the UK's financial future right now. We anticipate at least one official, Catherine Mann, will probably vote for no change.
Okay.
At the opposite end, you've got the archdove Swati Dhingra. She typically advocates for lower rates. She's likely to vote for a larger 50 BP cut, possibly joined by Alan Taylor, although his recent comment suggests maybe he'll stick to 25 BP moves this time.
Right.
Other key members to watch are Hugh Pill, Megan Green, and Dave Ramsden. The analysis forecasts 7 members voting for the 25 BP rate cut, with one dissenter in either the no change or 50 BP cut camp.
It's fascinating how those individual views play out. But if history tells us the vote split often has, very little predictive power for future decisions, like the analysis says,
Yeah.
why do markets still react so strongly on the day? Is it just emotion, or is there some subtle signal they're picking up?
Well, it's probably a bit of both, isn't it? Markets thrive on certainty, or at least perceived certainty.
Yeah.
And any visible disagreement, even if historically it doesn't predict the next move accurately, introduces uncertainty. It hints at the internal debate, the potential for future shifts. But the analysis wisely points out that the immediate market reaction often overstates the long-term significance of that specific vote split.
Okay. So given these deeply held divergent views within a monetary policy committee, the MPC, how is the bank going to communicate its future intentions? What about forward guidance for you, the listener, trying to anticipate the next move?
Yeah, good question. The expectation is that they'll offer very little in terms of forward guidance.
Really? Just keep it vague.
Pretty much. Besides simply reiterating its bias for further gradual and careful cuts, they'll want to keep their options open, maintain flexibility, given all these mixed economic signals we've been talking about.
Makes sense. Okay, so beyond the immediate rate decision itself, what other signals will the market be watching for? You hear things about quantitative tightening, for instance, QT.
Yes, definitely. Investor focus will also be on any hints regarding the bank's annual decision on quantitative tightening, or QT. That decision is actually due in September.
Ah, okay.
The question is whether the bank will reduce its current annual gilt reduction target, that's $100 billion right now, especially given some recent strains we've seen in the gilt market, or alternatively, maybe they'll skew sales away from longer-dated bonds. This month's monetary policy report will likely comment on QT's impact on bond yields, and that could potentially signal a slower pace of active gilt sales going forward.
Right, something else to keep an eye on. And finally, how might all of this play out in the foreign exchange market? Specifically thinking about EUR GBP. For you listening, what should you watch if you're tracking that pair?
Well, while the MPC meeting itself might not be a big market mover for EUR GBP on its own, the analysis does point to an asymmetry in where sterling rates might trade from here.
Asymmetry? How so?
Market rates seem to be lagging a bit in pricing in cuts. They're only pricing in about 55 basis points by next February's meeting.
Okay.
Whereas the BOE is sort of seen as being on this quarterly 25 BP cut cycle. So this suggests the risks are skewed towards more easing being priced in eventually rather than less.
Ah, I see.
And that could threaten upside for EUR GBP. Plus, you've got the noise around the November UK budget, which adds a sort of negative event risk for sterling.
Right.
This combination suggests that we should probably see good demand for EUR GBP near the 0.86 level, with a year-end forecast around 0.88 according to the analysis.
So you can really see that the Bank of England's August decision is far from simple. It's balancing a cooling jobs market with that stubbornly high inflation, all while navigating these internal policy divisions and thinking about broader market implications like QT and FX. It really sounds like they're trying to navigate a ship through both a storm, the inflation, and a fog, the jobs market data.
That's a good way to put it.
Yeah.
And it raises a really important question, doesn't it? How long can a central bank maintain this kind of gradual and careful approach when facing such conflicting economic signals and a deeply divided committee? What aspects of the economy might show the first clear sign of whether their current strategy is actually working, or if perhaps a more drastic approach will eventually be needed? That's the thing to watch.
A crucial question indeed. We hope this deep dive helps you feel more informed about the complex economic forces shaping the UK right now. Thank you for joining us.